Assalamualaikum warahmatullahi wabarakatuh. We are from Group 5. We'll present about our case study analysis of Corporate Financial Performance Apollo, Sendirian Berhad and FNN Holding Berhad. My name is Noor YASMIN binti BANI and my group members are Noor Syafiqah Akmal binti Muhammad Noor, Noor Syafiqah NAJIHAH binti ABDUL AZIZ, NURUL NABILLA binti ZULHISAM and NADZIRAH binti Muhammad SALLEH.
Good morning to madam. So my name is NURUL NABILLA. So the company we have to choose is Apollo and FNN. So now I will start with the company background. Fraser & Neff, which is FNN, is a conglomerate with interest in food and beverage. The company goal is to add value to people's life through innovation, economic performance, market presence, and sustainable sourcing. FNN creates economic value and improves livelihood. In September 1889, the company was founded. The founder was John Fraser and David Chalmers Neff, were already business partners in the Singapore and Strait Printing Office when they formed the Singapore and Strait Aeronautics Company. In 1892, the company was advertised as the largest manufacturer of soda water, seltzer water, lemonade and tonic, as well as the largest supplier to Singapore clubs, hotels and residents. The Singapore and Strait Printing Office formed a public company in 1898 to take over the aeronautics water business. The company was sold to a new company called Fraser & Neff, which is FNN. Apollo Food Holding Berhad is a holding company that is listed on the Bursa Malaysia under the consumer product and services sector and the food and beverage subsector. The company's main goals are to always meet the needs and requirements of its customer by utilizing cutting-edge equipment and technology. Liang Chiang-Heng is the founder of Apollo Foods. On 5 March 1994, Apollo Food Holding Berhad was established as a private limited company under the name Apollo Food Holding Berhad, with its headquarters in Johor Bahru, Malaysia. It operates in two segments, which is investment holding and manufacturing, marketing and distribution, with a focus on compound chocolate, chocolate confectionery and cakes.
Next, we proceed to liquidity ratio of FNN for 5 years. The current ratio was the highest in the 5 years in 2021. The current ratio shows the consistency of increasing ratio from 1.9 in 2017 to 2.69 in 2021. It demonstrates that company of FNN was able to pay off the current liabilities with current asset over the 5 years period. Next, quick ratio of FNN for 5 years. The lowest ratio in 2017 was 1.26. However, the value has steadily increased in subsequent years, but it remains 1. In 2021, the ratios were the quickest at 1.68. This demonstrates that FNN is doing better by not having difficulty paying current liabilities and having sufficient funds to meet financial obligations. Next, net working capital ratio of FNN for 5 years. In 2018, there was an increase of 39,131 ringgit from 2017, as well as in the consecutive years. Although the increase was slightly lower than in 2019, it indicates that FNN is gradually increased its financial obligations. In 2021, net working capital had the highest value of the 5 years.
Assalamualaikum and hi, my name is NURUL. My ID number 2021610416. Okay, now we're moving on to the activity or efficiency ratio, and the first one is account receivable turnover for FNN. Let's talk about figure 4, the ratio for 5 years. In 2017, account receivable turnover for FNN is 690, lower than the year 2018 with 713. In 2018, increased a more bit from the previous year. The ratio show FNN had increased their improvement and using and managing the credit. It extends to customers and they are capable of collecting the short-term debts. However, in 2019 until 2021, the account receivable turnover consecutively decreased. It may be caused by less efficient FNN in handling credit sales.
The trend analysis for leverage financial ratio FNN for 5 years, 2017 till 2021. Financial leverage is the use of debt to buy more assets. Leverage is employed to increase the return on equity. A ratio above 1.0 indicates that the company has more debt than assets. In 2021, only 46% of leverage stated, and it showed the higher financial leverage among the 5 years. This means FNN could handle their debt very well to buy more assets. Debt-equity ratio is a leverage ratio that calculates the weight of total debt and financial liabilities against total shareholder equity. A low debt-to-equity ratio indicates a lower amount of financing by debt via lender versus funding through equity via shareholders. A higher ratio indicates that the company is getting more of its financing by borrowing money, which subject the company to potential risk if debt level are too low. In 2021, FNN total debt is 812,976,000, while its shareholder equity is 2818,770,000. Then the debt equity ratio is 28.8. It is the lowest ratio of debt equity ratio among the 5 years.
Next is profitability ratio for return on total asset. In 2017, FNN had a 10.01 ratio, which indicates that the company did not effectively utilize its resource in order to generate profit. With an efficiency ratio of 11.51 in 2018, FNN was enabled to make effective use of its available resources in order to generate income. So the trend for return on asset ratio will continue to improve from years to year, beginning in 2020 and continue through 2021. This demonstrates that FNN present performance in terms of efficiency is a better good that it was in 2017 and 2018, and that this may be due to the company relatively low level of productivity. Next is a return on equity. In 2017, FNN had a return on equity of 15.16, which is considered to be fairly satisfactory. So this demonstrates that FNN was able to offer a higher return on investment to its shareholders. So in 2018, the ratio increased by a factor of more than 2 compared to the ratio from the previous year. FNN was able to improve its score to 16.65 in 2018, up from 50.16 in 2017. So this also provides insight into how effectively FNN management cultivate shareholder money. In contrast, the return on equity ratio began a downward trend in 2019, falling from 60.65 ratio to 50.24 ratio.
Assalamualaikum, my name is Noor Syafiqah and now I will be continuing with the trend analysis for the Apollo Food Company. The graph shows the current ratio for Apollo from year 2017 to year 2021, and Apollo has reached the highest value in 2018, which indicates there is an increment in funding to Apollo meet its financial obligations due within the year. The slight decrease in value for 2019 indicates that Apollo has less cash available to meet its financial obligations. Nevertheless, the company still managed to make payments using its current assets. However, in 2021, Apollo value of current ratio plummeted to 11.4, which poses a risk to the company as it is unlikely to have liquid assets left to cover its debts. Next, this is the graph for quick ratio from 2017 until 2021 with the initial value of 14.0 and ending in 10. The slight increase from 2019 to 2020 indicates that Apollo has managed to expand its financial income in order to meet its financial obligations due within the year. And however, in 2021, the value decreased dramatically to 10, which is due to the pandemic situation. Although Apollo has experienced a drop in value for quick ratio, the firm is still able to pay its current liabilities as the value is still more than 1. According to the graph of the net working capital for Apollo, the highest value recorded was in 2017. In 2018, Apollo experienced a dramatic drop of value which decreased to 134 million and it was the lowest recorded value throughout the 5 years. Nonetheless, Apollo managed to handle the net working capital and it had a steady increase from the year 2018 up until 2020 but decreased in 2021. This demonstrates that Apollo is focused on expanding its business while also investing in other endeavors.
Next is efficiency ratio account receivable turnover for Apollo. The turnover of Apollo account receivable was 766 in 2017, but it began to climb in 2018 and now fall anywhere between 766 and 961. The fact that Apollo is processing loan sales more effectively is demonstrated by this growth. So this is due to the fact that Apollo has a collection process, solid credit policies, or consumer that are economically viable or reputable. Asset turnover. The Apollo asset turnover in 2017 was 0.06 more than the turnover in 2018, which was only 0.04. Apollo is superior due to the fact that a company's ability to produce income effectively from its asset is directly proportional to the asset turnover rate. This demonstrates that Apollo was able to earn a revenue in 2017 that was proportional to its asset.
Next, based on the graph of financial leverage for Apollo in year 2017 to 2021, Apollo has a fairly stable value of its financial leverage, with the lowest being in 2018, which is 7.56, and the highest in 2021, which is 9.2. This indicates that Apollo could handle their debt quite effectively, even though the best ratio value is 1.0. Next is the debt-equity ratio for Apollo from 2017 to 2021. Throughout the years, it can be seen that Apollo has a low value of DER ranging from 0.082 until 0.101. A ratio of less than 1 indicates that the assets are mostly funded by equity. A lower DER ratio indicates that Apollo leverages its resources mostly through wholly owned capital. Moving on, this is the graph for return on total assets for Apollo in 5 years. In 2017, Apollo's value of ROTA was 6.45 and it decreased to 4.2 in 2018. A year later, the company managed to overcome the issue and the ROTA increased to 6.54, which was the second highest throughout the 5 years. In general, the higher the ROTA, the more efficient the company is generating its profit, and an ROTA of 5% or better is considered as good value for the firm. Lastly, this is the return on equity of Apollo for 5 years. Based on the graph, we can see that Apollo has a fairly high value of return on equity, with the highest being 7.33 and the lowest being 4.54. The company had sustained its ROE to increase from 4.54 in 2018 to 7.11 in 2019, which indicates a big growth for the company as they are able to generate profits from existing assets.
Next, we proceed with comparative analysis for both company for 5 years. For liquidity ratio of current ratio, Apollo has higher ratio than FNN. In 2018, Apollo's current ratio was increased and surpassing FNN's. A different trend occurred from 2019 to 2021, when FNN posts current ratio of more than 1, while Apollo recorded an up and down trend over a 5 years of period. The Apollo ratio falls from 16.65 to 11.14 in 2021. However, both food and beverage companies can still pay their current liabilities with current asset and still fulfill its obligation. Next is quick ratio. The quick ratio of Apollo's was the highest in 5 years in 2018. However, the quick ratio of Apollo has been decreased in 2019 and increasing in subsequent years. Apollo's quick ratio has fallen from 15.06 to 10 in 2021, and the company is still able to meet their obligations. Meanwhile, the FNN quick ratio has steadily increased over the last 5 years, from 2017 to 2021. Next, net working capital. In 2017, Apollo outperformed FNN in both 2017 and 2020. The following years, FNN improved and defeated Apollo. FNN has consistently increased its net working capital. This demonstrates that FNN has raised its funds slightly and has been increasing the funds over the last 5 years. Apollo's net working capital will plummet between 2018 and 2021. This demonstrates that Apollo had been decreasing the fund in those years. However, both companies can still pay their current liabilities.
The financial leverage ratio for Apollo is 9.2%, more lower than FNN that is stated 46%. It obviously shows that FNN can use their debit to buy an asset. In 2020, Apollo is decreasing to 7.69% and be increased to 7.98% in 2019, and still lower than FNN that's still higher, which is 23.5%. For 2017, the value of the financial leverage ratio for Apollo is 7.98 and still lower compared to FNN, which is 27.8. FNN still can handle their debt to buy an asset better than Apollo. Fundamentally, from the year 2017 to 2021, it can be concluded that FNN did better in managing and their financial leverage ratio to increase the return on equity and also has more asset than debt. The debt equity ratio for FNN is 52%, is higher than Apollo that stated 0.092%. It shows that Apollo is at the debt level too high. This shows that Apollo had bad record on debt equity ratio that it potential risk if debt level are still too high. For 2021, the debt equity ratio for FNN is 28.8% and Apollo is 0.101%. From the year 2017 to 2021, it can be concluded that Apollo did not do better in managing their debt equity ratio to decrease the debt level to avoid borrowing more money. A good debt equity ratio is around 1 to 1.5 and reveal that FNN have a good debt equity ratio than Apollo.
Comparative analysis profitability ratio for return on asset. When compared to Apollo and FNN, FNN was able to generate more money with the same amount of resource thanks to the company greater return on asset. Apollo return on asset was lower. In 2018, the return on asset ratio for Apollo is still lower than the FNN, which is a 4.020, while Apollo ratio is 11.51. It's possible that this is due to a decline in the demand for product manufactured by Apollo. Because a higher return on asset is preferable, one can basically deduce that FNN did a better job of managing its resource to make a profit from the years 2017 through 2021. This is because the higher the return on asset, the better. So it was determined that the return on asset for FNN is in the year 2021 was 22.39, while the return on asset for Apollo is 6.65. The return on equity ratio for Apollo in 2017 was 7.04, which is lower than the return on equity ratio for FNN, which was 15.16. If FNN return on equity ratio is higher than average, it indicates that the company management team is more effective at maximizing the use of investment finance to expand the company operation. So the return on equity ratio for FNN in 2018 is 60.65, while the return on equity ratio for Apollo is 4.54. So the difference between the two companies is due to the fact that FNN is more likely to give superior return to investor.
Now, account receivable turnover. In 2017, the account receivable turnover for FNN is lower than Apollo. That's that account receivable turnover at 690. Its view is that Apollo has efficient receivable collecting debt management with a low average collection period in that year than FNN. In 2018, both increased their account receivable turnover. FNN started to decrease year by year from 2019 until 2021. Meanwhile, Apollo has a much better average compared to FNN. Apollo has efficient receivable collecting debt management with a low average collection period in 2019 until 2021.
In 2017, the asset turnover ratio of FNN is higher than Apollo. It shows that the higher asset turnover ratio means a better efficiency in managing the resource. In 2017, FNN is still higher than Apollo, which is a difference of 0.05. FNN is consistently increased in the year of 2019 until 2021, which is 0.12. So, FNN maintained their investment asset to produce sales, while asset turnover ratio for Apollo increased in the year of 2019 but come back to decrease in 2020. In 2021, it will start to increase a little bit, which is 0.07. It is effective in utilization of all the firm's assets in its effort to generate revenue. The conclusion is each company is an efficient firm as well as getting better leverage asset to create revenue via sales by FNN is more efficient than Apollo in generating asset turnover ratio.
The conclusion based on the 5 calculate ratio, we analyze and compare the financial statement of both companies starting 2017 until 2021. So the result from both analyzation show the FNN Holding Berhad revealed better performance compared to the Apollo Food Holding Sinar Berhad, where the company scored 4 out of 5 ratio. However, the overall profitability of Apollo Food Holding Sinar Berhad is higher than FNN Holding Sinar Berhad. This is due to the increased financial costs. So from this assignment, we have collected info regarding to the event which have contributed to shaping of a company product as well as their profitability. So with the data analysis, we were able to make decision which company is a tech based. So the way to estimate the return and risk if investment through price, series and company performance drive effective decision making.